I'm Chris Vermeulen with Technical Traders Limited, and here today with me is Rick Rule from Sprott USA Holding. He's the president and CEO. He really needs no introduction if you're involved in precious metals or the resource sector. You've probably heard Rick before. Rick, welcome to the show.
Chris, thank you very much for having me on. I appreciate the opportunity to visit with your audience.
Thank you. Yes. All right. Well, let's kick things right off with something that really kicked the week off. Sunday, Monday, we saw quite the market shakeup for stocks and commodities. We had talks of COVID lockdowns overseas, which started some fear, but then we had the big global bank laundering of trillions of dollars, and that kind of shook the markets up, and I think it's still shaking the markets up. What does it mean to you? Do you think it's got a big effect on the market, or is this something that's just going to get swept under the rug?
I think it'll have very little impact on the market. Popular trust in the large banks or large institutions has been waning for 20 or 25 years. And the revelations that, as an example, banks might spoof or manipulate markets, or might launder money, or might assist governments in quantitative easing. The idea that the big institutions are involved in shenanigans, I would suggest is a certainty. And I would suggest that any listener who can either listen or read is sort of inured to the bad behavior of many big institutions. I'm not trying to be cynical, but it would seem that revelation after revelation after revelation has occurred. Certainly after 2008, it was very clear that the shenanigans involved in mortgage-related securities in the housing market, as an example, were horrific. And what did the Fed do? They allowed the big banks to pay retention bonuses to the same set of executives that caused the circumstance. So no, I don't suspect that much will change with regards to the regulatory authority. And I don't actually expect it to have much of an impact on the market until perhaps it's too late.
Mm-hmm. Yeah, I kind of feel the same way as well. I mean, everyone's used to the corrupt financial markets. Hard to trust a lot of people in the industry for sure. Now, you've touched on quantitative easing in the past. You've talked about it being counterfeiting. Can you explain this to us and tell us what you think it's going to have an effect on stocks and precious metals prices if we look forward 2 or 3 more years of this maybe continuing?
Understand what quantitative easing is. It's a circumstance where the central authorities, central banks in many cases, issue more currency than the economy would otherwise allow in a free market, which is to say that they debase the stock of existing currency by increasing it at a pace that isn't dictated by increases in economic activity, but rather dictated by a lack of increase in economic activity. Chris, if you did it, if you began to issue something called a technical or a CRIS, they would put you in jail. It would be counterfeiting. When they do it, it's policy, and it's enormously popular with the voters. But there's no denying that it debases the currency. There's no denying that this is a subsidy to spenders and a penalty on savers. To describe it as a good, I think, really depends on whether you are a beneficiary of this counterfeiting or whether you are a victim of this counterfeiting. Most of society ultimately becomes a victim of counterfeiting. But the people who benefit from it benefit from it to such a large measure that they constitute a rather large power block. And it's likely to continue because it's so popular. If you describe it as counterfeiting, people get very uncomfortable. And whenever I have this discussion in public forums, what I always hear is, yes, but. Yes, but means I agree with you, but I can't stand agreeing with you because the consequences are too harsh to consider.
Mm-hmm. Okay, yeah. All right, you've mentioned before that you think there's 2 bull markets that are unfolding here. So what are these 2 bull markets, and why do you think that's happening?
There may be more. There are only 2 that I'm familiar with.
Right.
That being the bull market in precious metals, and more laterally, precious metals equities. I believe that bull market is in fact well underway. I believe that to be the case because of all the policies that are put in place as a consequence of society's response to a free economy, are bullish for precious metals. Quantitative easing or counterfeiting debases the currency. Debt and deficits debase the currency, and savings denominated in fiat instruments. Artificially low interest rates penalize savers and subsidize spenders. An interest rate is obviously the reward that savers enjoy for postponing consumption. And it also compensates savers for the time value of money risk and the credit risk associated with savings instruments. I have been taught for 45 years that the world's benchmark security, the one against which all others are valued, is the US 10-year Treasury. Using that as an example, the US 10-year Treasury features right now about a 60 basis point coupon, which is to say savers enjoy, if that's the right phrase, 0.6% interest on their savings in a currency that the Congressional Budget Office suggests is depreciating by 1.6% a year, which is to say that if you invest in these so-called riskless securities, you are guaranteed a loss of 1% a year, compounded over 10 years. My friend Jim Grant calls this return-free risk. So I would suggest that your listeners have to determine whether or not gold can win a war against return-free risk. I believe, in fact, that it can. So I see a bull market already underway in precious metals and precious metals equities. Discussing this bull market involves a bit of historical review. I would refer your listeners to the Barron's Gold Mining Index chart, which I will offer up to your viewers at the end of this interview. Looking at that chart provides wonderful visual evidence of the two prior gold bull markets, one beginning in 1970 and ending in 1981, the other beginning in 2000 and ending, depending on how you view it, in either 2008 or 2011. 2 points to consider. The first is that gold bull markets are generally very long-lasting affairs. And they also feature, over the length of the bull market, fairly dramatic increases in the gold price. So when somebody says to me, well, you know, gold was 1,100, now it's 1,900, did I miss the boat? Well, in the 2000 market, the price went from $252 to $1,900. So the evidence might suggest no. The third thing that one gleans from this chart, and I suspect that you can help your viewers look at this, will be the incredible volatility rather than the mere cyclicality involved in gold and gold stocks. 15 or 20% cyclical declines in secular bull markets happen with the frequency with which you and I breathe. So people who want to play this broad uptrend, people who want to play what is potentially a 10-year market with a potentially 4- or 5-fold increase in the metals price, and if past as prologue, larger increases in the equity indexes, need to be buckled in for a wild ride, one where 20% declines punctuate 400% advances. The second bull market that I think people need to consider will not start, in my opinion, for 3, 4, 5 years. And that's an industrial materials bull market. And that one is much more subtle. And frankly, I'm not sure it's going to occur at all. I just believe it will. That bull market will have a very strange genesis. It's my belief that the world is in for 2 or 3 or 4 years of financial reckoning, meaning that we have to work off the excesses of a 10-year recovery, a recovery from 2009 to 2019, that was, from my point of view, more the consequence of artificial liquidity than it was any productive, increase in the productive capacity of mankind or an increase in wealth or trade. That is to say, a false recovery. A 10-year recovery in my career has been a recovery that's very long of tooth. And I think, too, that we need to recover from the extraordinary shock done to the global economy by the COVID-19 virus and the shutdown. If I'm right, I would expect that the current strength in industrial materials prices like copper subsides, because after all, they're economically sensitive goods. And if that happens, the ability of industrial materials companies to continue to make new project investments and sustaining capital investments will be very constrained. Constrained after a 10-year period where they have already been constrained. In my career, it is very rare, but when you balance supply and demand, not by increasing demand, but rather by destroying productive capacity, the upshot of that is a raging bull market. Because when you begin to experience tighter supplies and the pricing increases, the industry can't respond to the pricing signals by increasing supply because supply increases are so time-consuming and capital-intensive. If one witnesses the industrial materials bull market in the 2000 to 2006 timeframe, one will see the type of market response that I am expecting. So I do believe that we are in the midst of a precious metals and precious metals bull market, one that has legs, and the one that will reward people, pardon me, in 2021. And I think we're ironically setting the stage with weakness for an extraordinary industrial materials bull market that will occur at some indeterminate point of time in the future. For me personally, at age 67, and arguably in the twilight of my career, the idea that I exit in two bull markets, which is to say, you know, a sort of a 4 to 7 year reign of glory, really attractive to me.
Yeah. All right. Well, I mean, there's no doubt the precious metals market is very volatile. Just look at the COVID, some of the gold miner, the index really fluctuated over 50% on the COVID crash there. So definitely need to buckle up. I mean, I think a lot of people look at gold and metals as a safe haven. And I mean, I wouldn't say it's so much a safe haven, but it's definitely the ultimate insurance plan in case things really get nasty, which they are. And this, to me, is the perfect storm, as you've kind of explained, for metals and miners longer term. And these commodities got these 10-year cycles, major cycles. And I think you've got this 100-year commodity chart that you can potentially show the subscribers, followers after, that shows how these long-term commodities in general are, you know, at 100-year lows. And you look at the peaks and the troughs on that chart, and it's amazing. The tech bubble was the last major low. We're back down at those levels where everyone's piling into tech and online, and no one's thinking about resources. And resources have just gone to the wayside, and, you know, it's going to be very interesting. So I definitely see your side from a technical and even the fundamental side. It's like all coming together. So let's just talk about some of the ETFs that you offer at Sprott that actually cover the precious metals sector. So you've got your gold miners ETF, the SGDM and the SGDJ. Tell us a little bit about those and why you think they're superior to kind of the ones that are a little more popular, the GDX and GDXJ.
I would say that my preference for our indexes is simply that they're factors based. Most ETFs, including our major competitors, are based on market cap and trading liquidity, which is to say that there are no qualitative aspects to the selection at all. And the risk that you run in that circumstance, because gold mines are depleting assets, is that you own a bunch of large, stale, currently profitable companies that are mining their way to extinction. There is, first of all, very little emphasis in the competitive ETFs about revenue growth. Every day that you mine, your business gets smaller unless you're replenishing your reserves. A gold mine is not like a bakery. You can't pour flour and butter and salt in it and have their bread come out the back end ad infinitum. Every day you mine, your business gets smaller. So we emphasize revenue growth. We also emphasize what we call recycle ratio, which is the ability of the company to generate margin, which they can reinvest to add net present value. We think that these factors-based selection criterion and weighting criterion for the index do two things. They protect investors from stock selection, which is merely based on size and liquidity. In other words, they're defensive. At the same time that we believe it's likely that our index will overweight takeover targets early in a bull market. We have no documentary evidence of the latter claim, by the way. But we do believe that the characteristics that are exhibited by companies which would be overweight in our index would be criterion that would make them above average acquisition targets in the near term.
Right. That's very interesting. I mean, I don't think a lot of people know that. I didn't know that. And so you guys are doing a lot of work and finding, you know, some pretty sweet assets to group together. So I think that's a really critical thing.
One of the things about Sprott is that precious metals and natural resources is what we do. We don't pretend to be supermarket analysts or technology analysts or financial services analysts. We do resources, 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 and resources. And the consequence of that is that for a period of time in our private wealth business, we had client interest in the large ETFs. And in fact, when we began to analyze them from the point of view of recommending them to our clients with a straight face, when we looked at the concentration that they had, two things became immediately apparent to us. We could replace their market beta by buying a basket of 5 stocks with no management fee at all and de-risk the overall portfolio.
Right.
At the same time, the other problem that we had was obviously the sort of qualitative aspects of stock selection. The second thing, and this is envy speaking, the competitors' products have been so successful that in the case of their junior index, they outgrew themselves. They were incapable of deploying the capital they had. And rather than being a small cap index, I think the median cap was $3.5 billion. And at one point in time, almost 30% of the assets of the fund was invested in the ETF of their brethren, which is to say that as a junior gold mining index, they were too successful. It was impossible to deploy the capital that they had raised in the sector that they had raised the capital based on. We, sadly, haven't had to deal with that challenge.
All right. Well, talking about resources, let's switch resources a little bit. What about rare earths? Their related mining stocks have started to get a lot of traction in the news. There's continued talks of the trade war and commodity war with China, which China being the world's largest rare earth producer. What do you see all this trade war and the kind of the demand and price action for rare earths going forward?
It's fertile speculative terrain. I wouldn't describe it as investment terrain.
Right.
For several reasons. The first is it's a tiny, tiny, tiny market. And trying to find companies that are investable in the sector is impossible. There aren't any investable companies. There are some speculations that one can participate in, but one needs to draw the line as to whether one's an investor or speculator. The second comment is that rare earths aren't rare. They're substantially more prevalent in the Earth's crust, as an example, than gold. We haven't looked for them for 30 years because they've been in such tremendous oversupply in China. And any place in the world where there's exposed Archean terrain, where there are geological features called pegmatites, one can find rare earths. So as an example, in Wyoming in the United States, in the Canadian Shield in Canada, certainly in Arctic Siberia, in Brazil, there are lots of rare earths in the world. We haven't had incentive to go look for them because the Chinese have produced them so cheaply. Two things are happening now. The first is that, as you suggest, there are rumblings of a trade war. And there is a suggestion that the rare earths, being critical components in many technological applications, will be used by the Chinese as a weapon in the trade war. They threatened that once before, and they found out just how unrare rare earths were, and backed off, of course. The second, however, is very bullish for rare earths, which is that as Chinese society has become wealthier, the type of environmental degradation that the Chinese authorities were willing to suffer to produce rare earths has changed. And so the Chinese ability to produce these substances so cheaply was in substantial measure their willingness to ignore catastrophic environmental degradation in the mineral fields that were producing these elements. And as the Chinese increasingly upgrade their mining industry to develop world standards, which they're doing, by the way, very rapidly, what happens is that their cost to produce rare earths will go up and make other parts of the world more economic. One will note that there's a very large latent rare earth resource in Southern California at Mountain Pass. We've known about it. It was a prior producer, and it couldn't compete with the Chinese. As Chinese costs go up, the idea that one of the biggest treasure troves of industrial materials related to technological applications happens to exist in the state that's the epicenter for technological application, and is, in fact, bisected by Highway 15, will let you know just exactly how unrare these materials are. Right. This is not a place for an investor. This is fertile ground for a speculator. And I would suspect a speculator whose investment methodology is not got a hunch, bet a bunch, play the narrative. You're going to have to understand these individual markets. You're going to have to understand enough about metallurgy that you understand how materials that right now you can't pronounce report to various recovery cycles, and you're going to have to understand the efficacy of the material which reports to fabrication. So this is not a field for people who are foreign to study.
Okay. And what about switching gears a little bit? Like, I know you like uranium, and I know about 17 rare earth elements are found in, I think it's thorium and uranium itself. Is uranium based mostly out of China as well? Is that tiny cap, non-investment type of play as well, pure speculative?
Some of the process technologies involved in isolating rare earth isotopes from ore are compromised by radioactivity for fairly obvious reasons. So at present, with the exception of Olympic Dam, which produces a fair amount of uranium as a byproduct, most rare earths come from rare earth deposits or from ultramafic polymetallic deposits like Sudbury in Ontario. The Chinese are extensive importers of uranium. The biggest producers of uranium in order are Kazakhstan, Canada, and Australia. And we expect that to continue for quite some time. We don't see a circumstance, at least I don't see a circumstance, albeit from a fairly non-technical observation viewpoint, more of a financial viewpoint. We don't suspect that uranium ores will ever be substantial producers of rare earths, nor do we expect that the ranking or order of uranium producers will change much in the next 20 or 25 years.
Okay. All right, so let's go back to COVID for a minute. Here's kind of the last big question. It's pretty loaded. What happens if COVID-19 rears its ugly head again and we start to get lockdowns in the US or in a bunch of other countries, similar to what happened in March? What do you think could happen to the stock market, to metals prices, in real estate this time around? Because we know that first one was definitely ugly. If it was to happen again, I mean, we're in Canada, we're looking at, they were talking about 30% of companies on the verge of bankruptcy. If you tell them there's another lockdown coming, there's going to be a lot of people having to walk away and shut down. And what would be a way to potentially protect ourselves, or what are your thoughts on the whole thing?
Well, I think the policy response to that will be more counterfeiting.
Right.
More debt and deficits, and artificially low interest rates for longer. I think that will occur whether or not we have a resurgence in COVID. In fact, I think thinkers have painted themselves in a corner by relying on those instruments, in fact, prescribing more of the illness as the cure. In the event that we have a large resurgence of COVID, I suspect it would be very damaging to the broad economy. Confidence is already weak. And if you weakened confidence further for very real reasons, You know, my suspicion is we haven't had a good old-fashioned recession of the kind that we enjoyed, if that's the right word, in my youth for a very long time. They've been outlawed. And I think that there's a belief on the part of the general public that the big thinkers of the world, the central bankers and the legislators, are somehow bigger than the market. And my suspicion is the longer that we believe that, the uglier the realization becomes when it becomes. I need to say I'm a credit analyst. I'm not a broad market analyst, nor am I a technical analyst per se. I'm actually really a good old-fashioned green eye shade credit analyst. But I wonder how long confidence in central bank magic continues. People who are economists tell me that an ever larger measure of fiscal stimulus is required to get a new unit of economic activity over time, which is to say that counterfeiting and artificially low interest rates become progressively less effective tools. When you stimulate economic activity in the near term, all you've done is steal it from subsequent periods. Yeah. When you get to those periods, the demand that normally and naturally would have been there has already been consumed. And the consequence of that is that you have to increase the level of stimulus relative to economic demand. If you give economic demand in the near term another kick in the gut from COVID, having already stolen the normal and natural demand that would occur in that period and forward shifted it to other periods, obviously you begin to have a difficulty. I would suspect with regards to broad equity markets, many of your listeners are ETF participants and probably very broadly based ETF participants, that a lot of the equation will come down to confidence. If the broad public begins to really question the ability of governments and central banks, questions, if you will, the Fed put or the Greenspan put, then my belief is that you have a genuine recession and you probably have fairly ugly impacts.
Right, okay.
In the broader equities markets, with the caveat that that isn't my field. I can tell you, I think in a related topic, you know, we've been in a bond bull market since 1982, a 38-year bull market. I've never seen a 38-year bull. Well, obviously, I'm only 67 years old. I wouldn't have seen a 38-year long market. But the looking at the progression of interest rates, which is, of course, the inverse of bond values, suggests with the U.S. 10-year Treasury in 1982, the yield was above 15%. Now it's below 1%. That will tell you that bonds have been in a hellacious bull market for 38 years. But obviously with the yield at 60 basis points, that market is much closer to the end than to the, irrespective of the actions of the federal bankers. Can they take the interest rate to minus 15%? At some point in time, it doesn't make any sense to buy bonds. It makes sense to bundle all your money in hundreds and put it in a safe deposit box and let it get moldy because it depreciates less fast.
Right. Well, thanks for all that insight. Are there any final things you want to share with the with the followers here?
There is. I delight in conversations like this, and in order to encourage them and facilitate them, I offer something of value. Any of your listeners who have been amused by this and would like to know more about what I and Sprott think of resource markets are invited to go to a website, www.sprottusa.com/rankings. There you will find a web form. And if you enter in the web form your natural resource equities or ETFs, I personally will rank them 1 to 10, 1 being best, 10 being worst. And I will comment on individual issues if I believe that my comments are of any value. In addition, I will include the 2 charts that we've talked about in this interview. One, the Barron's Gold Mining Index, included because it's the broadest and longest running of the gold mining equity indexes available to me. And the other, this fascinating 100-year commodity chart that talks about the valuations of commodities relative to other asset classes going back over 100 years. I'm not a technical analyst, and so I won't, pass any discussion of technical merit of these charts, but they're an astonishing visual tool that shows you, first of all, with regards to the gold equities market, where we are relative to prior markets. And with regards to the commodities chart, it's an absolutely fascinating visual discussion of the valuation of the stuff of man relative to other asset classes.
All right. Well, Rick, thank you for taking the time to talk with us today. And you shared a ton of insight, lots of value, and you're providing more value to everyone listening to get ranked, get their portfolio ranked. So thanks for being on the show, and hopefully we'll talk again in the future.
A pleasure. I look forward to it. Maybe we can talk about oil and energy next time. Another good topic.
Sounds good. All right. Well, take care.
Thank you.